We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Melody Wright, strategist, writer, technologist, and GFC1 survivor. Melody, thanks for joining me today.
Thank you so much for having me, Tom.
I'm really looking forward to this interview. And, it's going to be obviously a little bit different than most of what I cover normally. But I think it's an extremely important topic to be able to understand and get a good grasp of where the economy and where the country is as a whole right now. So why don't we start by getting a little bit about your background and why and how you've become such an expert on the U.S. housing market?
Sure. And it starts as being a failed academic, Tom. Like I thought I would be a teacher and a writer and, but somehow I started studying macroeconomics and the World Bank and the IMF and literature of countries who had gone into debt to be sort of rescued financially. And that's what I did. And when I realized, I was going to have to pay those student loans back, I had to get a job that would pay a lot of money. And while I was in grad school, I worked at the Wall Street Journal. I worked at an investment banking firm. And so I always had one foot in business, which is why probably I started going down the economics path while I was in grad school. But when I quickly learned that I had to pay those loans back and it wasn't, no teaching job would ever pay for that, I got a job at a mortgage bank, a mortgage non-bank, importantly at the time. And this was September 2006, right before everything just absolutely imploded. And so, from there, I had a front row seat to everything that happened. I started in the executive suite. And so I was able to get an education that most people just can't ever get about mortgage, and specifically what happens when you take on more debt than you can handle, not only as a household, but also as a country, because, we then had bazooka style intervention in the mortgage market to keep it from completely imploding. Everybody thinks that it did, but in reality, it did not. It really slowed down. They did a whole bunch of different things like loan modifications and workouts. So it really slowed down the housing crisis. So fast forward, how did I get into the economy and what I'm doing today? I worked at a whole bunch after the GFC and after everything I went through, I tried to teach other non-banks about the new regulations. And this is important because what happened after the GFC and the great financial crisis was that a lot of the lending went to the non-banks. The banks stopped doing it. They had to pull back because of certain regulatory requirements. And so you had these non-banks who don't have deposits, and that's very important. They have to borrow to lend. So it means that their interest expense or what they pay on their debt has to be less than what they're getting in. And so essentially, these folks got in, they've gotten in way over their skis, but I went out to work for them, trying to teach them how to do this the right way. There just wasn't a lot of interest. And that's when I started getting suspicious about how much had the lending environment really changed, even though everyone inside was saying that it had changed drastically, that credit quality had, strengthened. Well, fast forward, after trying my best in those non-banks, I kind of went to technology as a way to solve a lot of the problems that I saw there. And then in a fintech company, because of my background in macroeconomics and kind of just finance, they said, please let us know when rates are going to rise, because they knew when rates were going to rise, everything in the industry was going to slow down from an origination, a mortgage loan production. And Tom, please stop me. I'm using a lot of terms that I know people aren't going to understand. So just always stop me when I say something. But essentially, I started just diving back into macro, diving back into, at the time and still today, everybody was talking about the Fed. But I was like, why are you talking about the Fed? They don't they don't control mortgage rates. This was the 10-year treasury controls mortgage rates. And that means the bond market controls mortgage rates, not the Fed. And so what I did is not
that overnight rate, right?
Yeah, exactly. I just familiarized myself with the show, Tom. the macroeconomic show and all the inputs and the drivers. And what I realized is there was a lot of noise. And then I focused, of course, on my housing expertise. And I woke up one morning in January of 23, and I saw a column from Bloomberg about how the housing market was turning around. And I was like, are you out of your mind? And it made me get out on the road, because the biggest story we were all getting at the time in the United States was a housing shortage. We had a inventory shortage, and I'm just looking at demographics. I'm looking at how many houses we have. I'm looking at this short-term rental craze. I'm looking at all the biggest building pipelines we'd seen since the 70s in multifamily without the demographics to support it. The biggest new build for single-family homes, and then people were doing this thing, building these called built to rent, because people, when they were priced out of home ownership, they wanted to live in something that looked like a home. So building was exploding everywhere. But everybody was talking about a shortage. I was like, you're crazy. We have 15 million vacant homes in this country right now. So I went on the road, and I've driven well over probably now 20,000 miles to all these different cities, and realized, yes, indeed, we have overbuilt again. No, credit quality is not better. The government just stepped into where private was. And everybody was asleep at the wheel, just like they had been before. So that's the long answer to kind of how I got here. But I think that my expertise and that what I witnessed in the great financial crisis made me way more understanding of these different drivers, when a lot of the people, and I forgot to mention, Tom, that after I helped my company file our bankruptcy back then, my president asked me to oversee and fix default. So that's through foreclosures. At the time, I was managing over 65,000 foreclosures. So I have kind of experience on both the loan origination side and then the back end, especially with default. So it just kind of gave me a unique viewpoint. And then, because we're getting what, mainstream wants us to see. And so the other thing I would say is I just use my eyes to understand what's really going on out there. Sorry for the long answer.
No, that's perfect. I think that context is really important to understand kind of your background, and then really get that sense of why this works the way it does, right? So right. I want to start maybe by, let's say, separating out something that we've talked about and heard much more about, and that's, let's say, the commercial side of the inventory here, especially since COVID. That has been such a game changer for the commercial side of things. So is that, almost the tip of the iceberg into what you're now seeing in the residential side?
Yeah, they're interlinked, and this has been so funny to me to see how people want to de-link them. But one thing I want to say is that we were in trouble from commercial real estate really since 2008 and before. We've overbuilt, and basically what everyone does is they try to use commercial and residential real estate and construction, particularly, to drive the economy. This is why you'll go to somewhere like Dallas and see these massive high rises that are completely vacant, but really 5 blocks away, they're building a whole new spangly building without ever taking that one down. And you've got, like a baby stroller and kids' toys out the back of it where people are living there. Yet, everybody's focused on those new fees, that new origination. And so I think this is important that commercial real estate, our issue there is not just about COVID. Mm-hmm. It's about that we absolutely overbuilt commercial as well. If you've ever watched The Big Short, mm-hmm. and you see the very first scene where they're building up all the skyscrapers, this was to hyper-financialize our economy through real estate. And so, for instance, where I lived in Pittsburgh, right as COVID was starting and before COVID, I had an empty Class A office park next to me with almost 21 Class A beautiful buildings. This was going to be a live, work, play area where they had a daycare, they had restaurants, the whole little fake downtown, you know what I'm talking about, the nail shop, the yoga studio, all that good stuff. And it was virtually empty before COVID. After COVID, completely empty. And they'd built up all this multifamily around it, and it was all Class A. And so people are going around saying it's Class B, it's because of work from home. No. we use this to hyper financialize the economy, and then we sell off that debt, things like that. And so, but residential is linked, because what you'll have is, like, let's take Raleigh, North Carolina, where Apple promised, and I put that in quotation marks, they're a new headquarter. Okay. They've been promising for 5 years. And it just keeps getting delayed and delayed. But what you have with all these residential projects, all these developers thought, oh gosh, everybody's going to move to Raleigh because of Apple, and they're all going to have these huge salaries. Well, in comes all the tech layoffs, and that project's not being built. So you can't really look at these things in isolation. You take Austin, for instance, that was going to be the new tech hub. I can't tell you how many times I've heard, I lived in Denver, that was a new tech hub. There's always a new tech hub. Raleigh's a new tech hub. And so they went crazy building all this new multifamily luxury homes, et cetera, new commercial as well. But that's no longer the case. Austin's lost its shine. And so, the two really go hand in hand. And we've just started seeing the actual people actually taking losses in commercial. This is, like you say, the tip of the iceberg. And it's going to wash over the banks. And, this is why multifamily is what is showing in terms of rate of change of delinquency. It is accelerating the fastest because people just went bananas.
Mm-hmm. So trying to get a sense of, let's say the default rate and how that is really starting to accelerate here. How has this really changed since, you saw this starting in 2008. We saw the housing crisis in 2008. Obviously, COVID threw a big wrench and a very odd supply and demand dynamic into the housing market as well. So, talk us through a little bit about how you've seen the market change over the last 15 years.
Such a good question. And it's so important. And honestly, I think that I've really started to step back and see the housing market, Tom, as starting this cycle as starting in the late 80s, when we really went all in on, mortgage-backed securities, and the private space. And I mentioned, the fact that this has been about driving the economy. But this is something I've just started doing, asking everyone I know, what do you think the current average household size is in the United States right now? And this is to illustrate a point.
Like number of people?
Yeah, what number of people? I mean, back when I was younger, we'd hear something like 4.2, and the 0.2 was your dog, but no, it was just the 0.2, But what do you
the average? The first number that came to mind was about 5.
In the United States, it's 2.5. That's just taking population divided by housing stock. And so what the housing market, and you saw that just really contract starting back in the late 80s, because the housing market is no longer about first-time buyers, primary residents. It's all about investment. It's all about second homes. It's all about these short-term rentals, these, fixing and flipping for long-term rentals. So, because what happened, the prices collapse, you get a wave of people that get wiped out of the market. Well, those that didn't get wiped out have a little capital on, and they start going out and buying these homes to fix and flip them for long-term rental, because people really couldn't afford to buy. And so rents were going up. So you saw these television shows. I say that the biggest real estate influencers out there are the Kardashians. I've forced myself to go watch that show, and you can just see that the entire thing is about real estate. And so it all became this kind of ethos of passive investment. Like, if I can just buy one of these homes, I can get rental income, okay? Because my company really has no allegiance to me. They're not investing in me. Like, we saw this so much, companies focus on share buybacks and things like that, not research and development, not, enriching their employees. And so people are like, how am I going to make it? I can't make it, And so then comes short-term rental, which has been around. And so what I'm saying, for some that are like, what are you talking about? That's Airbnb, right? And it's been around for a very long time, not Airbnb, but just this concept. Like, it's a big concept here in the Smoky Mountains, because, you're not going to have a big Hilton or Marriott. You need a little home in a cabin. Well, they just went nuts. And Airbnb was very strategic about the way that they did things. So, for instance, if you go to San Diego right now and you try to search, you'll get 1,000 listings and it'll say 1,000. So you think, whoa, there's 1,000 short term rentals. I'm a host, there's 1,000 short term rentals. San Diego needs more than that. No, there are 15,000. They will only show you 1,000. They don't give you any kind of reporting, they don't tell you anything like that. And so then you had companies like AirDNA come along saying, hey, we're going to give you analytics on this market. We're going to tell you what your average daily rate is, et cetera. Well, then the banks, Tom, started using that technology to underwrite loans. And so people came in and they said, hey, I want to buy a short-term rental. And the bank said, and let me say particularly non-banks here, this is primarily who is doing that, would say, well, why buy one when you can buy 10? And so essentially you have just seen wild speculation in the housing market. And so when everybody thought it was a housing shortage for you and me, no, it was a housing shortage for investors. And I would say big mom and pop investors, like over 100, not necessarily institutional, because they really started seeing the writing on the wall the minute rates started to rise and became net sellers in many ways. And so this is how you've seen, I think, since the late 80s, the housing market just transformed. We had the lowest amount of first-time home buyers last year since they started, the NAR started the series in the 80s. So this market is no longer about families having a home, because as you say, then the average home size would be around 5 or 4 or even 3. But we know that, our demographics are pathetic. We're not even at a replacement rate here in the United States right now. And the boomers are the, largest majority homeowners. And Harvard has told us that 15.6 million of them, unfortunately, will be leaving us between now and 2035. 25 million from 2035 to 2050, and they own the majority of the homes. And so these are going to start hitting the market. I mean, honestly, we saw that inventory surge in the spring, but those that can wait have started to pull back. But with recent moves in the bond market, I think we're going to see similar to what we saw last year, and inventory start to accelerate non-seasonally again if we see lower rates in the fall. And that was a lot again. Sorry.
No, that's perfect. I'm just trying to explain to me again the link between lower rates and more inventory.
Because
I would instinctively think it would be the opposite.
We have more sellers than we do buyers because of affordability. So despite what mainstream media talks about the housing shortage, I track inventory in 85 markets each week. There is plenty of inventory. It's just misallocated or incorrectly priced. And so the sellers are those that can wait, which are a lot of these boomers that own these second, third, fourth, fifth homes. They see when rates go down, they're like, oh, somebody's going to be able to buy my house now, so I'm going to list it. But nobody wants their house to sit on market for 65, 70 days. It doesn't look good, especially if you're not doing a price. And if you do price cuts, the people in the neighborhood get real mad at you if you do something like that. And so right now you have a lot of people that I would say are motivated, but not distressed. But what we're starting to see in the U.S. housing market is motivation is turning to distress. And so I think that very similar to last year, if what happened yesterday over the last couple of days, and we see mortgage rates where they are, it's almost an identical move to what happened last year. We'll have inventory even start to grow again. It usually starts growing again, usually in October when Florida and Arizona start their season because they have a very different selling season. But I think it could start even sooner. But we got plenty out there as it is right now. But these lower rates, believe it or not, and this is going to sound counterintuitive as well, actually bring on lower prices because it just brings more people to the marketplace. Yeah, exactly.
Melody, how has let's say the median age of the first-time home buyer also changed over the last 10 to 15 years? We always hear about the idea that there are, the younger people are basically getting priced out of this market, A, because of demand, B, because of inflation. So how has that median average age changed over the last decade to 15 years.
It's just gone up like our stock market. And people want to, I mean, honestly, all of these things have these, repercussions, but it just keeps getting older and older and older. And I cannot remember the exact figures, but I think we definitely had the highest median age of first-time home buyer, I think in the 30 plus, something like that. But the average is 50 something, I believe. I don't have the exact numbers, Tom, but I know the trend, and I know that, we hit the highest median age. And so somebody on X Twitter shared a chart, I think yesterday, of just like the difference of how many people who own homes are, below 30, like over time. And I mean, we have completely priced out our younger generations. And this is it's why I do what I do is, try to bring awareness. Because my fear is what we had during COVID was a lot of FOMO, YOLO, into a mortgage that people could not afford because, the government did everything they could through these programs and down payment assistance to get people in. Unfortunately, what it does is it erases future purchasing power and it destroys families because, what do couples usually fight about? Money is one of the biggest ones. Anyway, that's it. Tom, it looks abysmal, honestly.
You've mentioned that there are non-banks being a big source of financing here. So explain to me the difference between a bank and a non-bank when you're getting your mortgage, and if that, let's say the asset side of the non-bank issuer is an inherent risk within this market as well.
Yeah. That's a good, there's a lot of good points in there. So, a non-bank, my former company we were the redheaded stepchild because we were the only big non-bank of the top 5 that included Chase, B of A, Citi, Wells, and us, the redheaded stepchild. We had a tiny bank in Utah. We would later become a bank holding company so we could get TARP funds, but we were never operating as a bank. So typically what your big banks do is they lend off those deposits. Like they don't need to go borrow money from the marketplace because they have your deposits that they can lend out. And so what the non-banks do instead, and so let me say this is Rocket, this is United Wholesale, this is they might even have the name bank in there. So you think it's an actual bank. I see this a lot of times with mortgage banks. So when you sit down, you don't really know the difference between, if you're doing it, let's say online where you start your process versus going into your local credit union or your bank. But the key is they have to borrow money to finance your loans. What they're doing is and so this is how the government arm has really juiced up, their presence. They are now 85% of outstanding mortgages they own. That's very different from prior to the GFC.
Is that through Fannie Mae and Freddie Mac?
That's correct. And FHA and VA, which those get securitized in Ginnie Mae securities. So what happens is when the banks pull back on lending, people still needed to juice the economy. And so the non-banks stepped up and they could get cheap funds, very cheap funds. And so and it's a game. It's a Ponzi like everything else. You buy, so you fund that loan. So I give you, let's say $400,000. You buy the home. The non-bank lender, turn around immediately to Fannie Mae, Freddie Mac, or an aggregator or somebody. I sell that loan and I get some upfront points. I get some juice on that. Because theoretically, they want to buy the underlying servicing strip. This gets very confusing, so stop me, Tom. But this is where people want to service your loan because you get a tiny little fee each month to service that loan. And it also acts as a hedging asset. It becomes an asset, that mortgage servicing right. And that's just the right to take your money every month to pay your bill unless something goes wrong, like you need a loan modification or a workout, then they're going to help you with that. and then somebody's going to pay you a fee for doing that loan modification or workout. And this gets to the second part of your question. So the non-banks are very exposed here. And we have never had this much presence of a non-bank in the mortgage lending market. And the game has worked okay because there's been a couple of tricks that were played, including the agencies like Fannie, Freddie, FHA, VA paying out fees for the servicers to do these workouts. But those are getting limited on the FHA side, which is a big part of that in October. And the thing that you have to know about these crazy security agreements is that non-banks have to advance your payments even if you don't pay, Tom. So, and they have to pay your property taxes if you don't pay, and they have to pay your insurance. This is all part of the contractual agreement with the government. And so all of a sudden I'm a non-bank, and when my delinquency ticks up, I'm out all this cash. Well, theoretically, you're going to be paid back by the government at some point. The problem with that
non-banks will be paid back by the government? Okay.
Theoretically, but the way that this game is played, it's like any other insurance company. They delay your claims, they quarrel with your claims, and then a lot of their requirements mean that you're going to mess up, period, because they have contradictory requirements. And so very, very suddenly, if you're not getting that loan origination at a certain level, on the back end, your liquidity just starts to decrease. Mm-hmm. And you're already seeing this. This is why Rocket is purchasing Mr. Cooper. They had a very aggressive debt maturity schedule. They need a lifeline because the other thing that'll happen is if a loan goes bad for some reason, those agencies turn around and make you repurchase it wholly. So let's say you owe $450,000. Out of nowhere, I get a letter and I just have to fork over $450,000 and carry a loan that's in default, which is a huge expense. Mm-hmm. And so I could talk about this for like 2 days, Tom. So I'll stop but these non-banks are in serious trouble, and it's just starting because the origination has crawled back so far that and if the loan modifications get limited as well, they're going to be in a very bleak liquidity picture.
Mm-hmm. Well, that's why I wanted to understand the difference between banks and non-banks, is because as you began to describe it, it seems like they don't really have the same assets that a bank would, and to be able to provide that cushion within themselves, right? But I want to zoom back out to understand a little bit more about what this actually ends up meaning for the U.S. economy as a whole. It really seems like this is an excellent data point to be able to understand and really gauge the idea of the health of the U.S. economy. So how do the combination of this slowing market, the issue of non-banks as well, and job openings all play in here? I know it's a complex question, but I think that is really what we need to be able to, or one of the data points that we really need to be able to get a good grasp on in order to gauge the idea of a possible recession coming here.
It's such great questions, Tom, and it's been a long time since I've had people kind of tie some things together that really need to be tied together. So I'm enjoying this. Thank you.
Excellent.
So very early on in FHA, so I'm going to answer your question, but I want to explain what FHA is. So FHA, always back when I was in the industry, I always just thought of it as a first-time home buying program, but really it stands for Federal Housing Administration.
Okay.
And what this program is supposed to be is to give people who maybe aren't as well off kind of a hand because in the U.S. we've been told everybody owning a home is a right, and even if you can't afford it, and that's ridiculous. I mean, that just is going to cause a whole bunch of trouble. So anyway, they went bananas on FHA. And this is where they basically took the share. And I did a post called Baseline a year and a half ago, where I showed, just because everybody's like, this is nothing like 2008 credit quality, blah, blah, blah. I'm like, no. What FHA did is it's so the private lending used to be the big problem back in the day. Private lenders got crazy, were giving out loans, hand over fist. But what happened is FHA just flipped with private and they took the market share and they've doubled and they now really hold the same exact percentage place that the FHA did. And this long-winded answer, but I was monitoring because they went delinquent, like crazy delinquent. Right now they're at over 11% delinquency. That's insane. And it's almost 15% of the market, between 13 to 15%, but nobody's really talking about it. Okay. So I've just been pounding the table, but they do this loan performance trends report. And very early on, you could see the unemployment and reduction. Like they do this thing where they say reason for delinquency, for serious delinquency. And they do a schedule that says, is it unemployment? Is it reduction of income? Is it death? Is it we can't get into contact with you, so we don't know? Well, you could see unemployment going up, 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 even when no one was talking about our labor market because of some crazy, stupid math equation that everybody focuses on that has really nothing to do with how the labor market is functioning in the United States. And so I could see the unemployment there. I could see the loss of income growing there. Then you had this thing called the Census Pulse Survey, that they launched during COVID, where they would call out and they would ask a set of questions about, are you 30 days behind on, because when we weren't doing evictions, when everything was in a mortgage forbearance, really the Fed and the government had no way of knowing what's the true sign of distress out there. So they did this thing called the Census Pulse Survey. And what you would see on there, and it asked questions about employment, and it looked like people were way more unemployed than what was being said out in the mainstream media. And so the point of this is that the housing market has been telling us for some time that the consumer is in bad trouble. I mean, when I tell you that June sales, and I'm taking both existing homes plus new, so I call that combined sales, were the lowest behind just last year, going back to 1999, and we've increased population by 20%. You know, the third lowest, June of 2008, okay? And so in the existing home market, we had the worst housing sales last year since 1995. You got to think that should be growing as a population increases. And it's not. And so the consumer is already telling you they're done. They're tapped out. And, we know that the top, 10% does 50% of consumption. Mm-hmm. And so it's really been able to mask and hide a lot of that distress in our middle income tiers and lower income tiers. And so I think what the housing market is telling you is like, wake up, people. I mean, the consumer is completely tapped out. And there just is only so many homes that our top 10 or top 1% are going to buy, because they themselves, they can't get insurance. So they've suffered losses in California, because those are just uninsurable properties. And in places like Florida, where people have been canceling insurance, or it is astronomical, their property taxes are going up, especially if it's a second home. And so it's just not affordable to keep these homes. And so what you saw in 2024 were the top 10% barely keeping it alive. But that's what made that median home price look higher. It wasn't because, all of a sudden everybody can afford that crazy median home price. It was because the only people really transacting were those that could afford it, or those being pushed into the market through these government programs. So, and you mentioned job openings. I mean, I just think that we're seeing layoffs. We're seeing reduction in job openings, mm-hmm. and you're seeing the highest multiple job holders we've seen going back to the early 2000s. Like when you look higher than the early 2000s, higher than the GFC. Mm-hmm. So that tells you that the consumer's under stress.
Yeah, I think being able to understand these problems, let's say from the Fed's perspective, to get the proper quality data, to get a real data set, I think is such, unfortunately, it seems like such a challenge. Every month we get these insane revisions to the job numbers, right? To the job opening numbers. And it's only the headline, the initial reporting that gets gets the
play.
attention, and then once it comes back in to the revision, it's completely different. I know you've talked with Danielle DiMartino Booth quite a bit, and she's even mentioned on the show before the idea of the anomaly within the data that includes severance, right? You're still counted as an employed person if you're under severance pay. So there's all these challenges within the data, and I think this is illustrated really well in this market by the difference between MLS listings versus private listings, right?
Yeah. Yes. I mean, that's a whole rabbit hole, Tom. But yeah, I mean, I think that you have I think we again, it's so important to realize that the housing market really has not been about regular Americans for a very long time. And so during COVID, there were a lot of people partying and doing so privately, as you were saying, like they would do private listings where you and me would never see that listing, and there would be a whole network of individuals. And so this is another thing that I think people have to take into consideration, is that you have a very large lobbying firm called National Association of Realtors, who is the highest lobbying firm by spend in Washington, who is trying to hold on for dear life to their empire, but it's being eroded by technology. And also because I feel there has been kind of a shadow housing market that has sprung up for investors and folks like that, where it really is also kind of skewing the data and making it impossible to understand what's going on, because there's hardly anybody out there that actually looks at recorded information on public record. They use these multiple listing sites, which are controlled by NAR primarily. And so what I've come to understand, Tom, is there's a lot of monkeying around with the data, a lot of revising the data, but think about revising it behind a wall versus, at least we get to see the revisions to the labor data. We don't even get to see it in the MLS. And I've started to find instances where, very convenient revisions, put it that way, like the median listing price. Realtor.com is who provides that to Fred. Fred, as you know, is a big data site where you can get a lot of data. Not too long ago, a few months ago, they just decided to revise last year's June median list price. Now, why would you revise a list price? That should just be, what's the median of all the prices listed on my application right now? Mm-hmm. And why would you do it 7 months later and never put a revision note on the data set? Well, because if they had not done that, year over year, median list prices would have come in lower this June. And so there is a real vested interest in pushing a certain narrative through data sets that, we really, a lot of times we are just blind to the information. And that's a big part of that private market that's operating out there. And we don't know a lot about it, but we do know that there's also a complete private lending market that has sprung up, where people are doing seller financing and all kinds of really risky stuff that people aren't talking about either. So basically, we've created this really gnarly growth on the side of the housing market that nobody really understands how it's working. And that worries me, because here's the thing. When you had all of that inventory on banks' balance sheets and things like that, then they were responsible for paying property taxes and insurance. Mm-hmm. Well, these private lenders who got in this without all of that infrastructure, they won't be paying those taxes and insurance. And pretty soon, counties are going to have a real issue of all these empty houses out there that everybody, it right now is still denying exists. And I've seen them with my own eyes. And so this is going to be a real issue for the municipalities in the future. But hopefully I answered the key question there.
Mm-hmm. Melody, how do you try to separate out the differences between these markets? You said you pay attention to 85 different kind of, let's say, breakdowns within the country, but how does that also break down, let's say, between the differences within the value of homes on the market? It seems like when the people that have money always have money and have the ability to transact, to some degree. But how is the, let's say, the nature of that changing, which could be another warning sign as well?
I just think that we did a lot in 2021 to convince ourselves that everybody was getting rich and that we had more rich people in this country than that actually are. And so I like to watch the luxury markets, Tom. Mm-hmm. And I've been seeing really since I started in 2023, a lot of luxury increasing that's sitting and not selling. A lot of price cuts and things of that nature. And one of my favorite things to do is Realtor.com has a celebrity real estate section. And it is just shocking how many people are listing their beloved home of 20 years. Because again, rich people don't stay rich by spending stupid money. Like, why would they have 6 homes and be paying for a home they don't live in? I mean, and so I think that what we've had is we had a lot of foreign buyers. We still have foreign buyers, foreign wealthy buyers that use the housing market. We have a lot of really rich folks that, we get our new NVIDIA millionaires, for instance, but they're not saving those California markets right now. They're not. In fact, you're seeing price cuts and year-over-year price drops in California, which everybody told me would never happen. And so they're just going to run out of, we're going to run out of enough rich people to even sustain the luxury market, because I cannot emphasize how much luxury spec has been built. And I mean, Tom, I don't know about you, but I don't think I would have the courage to build a $30 million spec home where somebody just might come buy it. I hope. Mm-hmm. If not, I mean, I'm completely on the hook. I may have sold out some exposure to it. But you just have a ton of players that have been building luxury spec. And so I think, this is where people start to call me a crazy person. But, I think that you go back to the golden age of Long Island, you go back, a lot of those mansions don't exist anymore. And they were torn down. And I think we will probably see something very similar in the next few years.
Melody, we've kind of peripherally touched on the idea of demographics here. What's the best way to understand the issue of demographics within this economy and within this market?
It's so important because you need those rising demographics for your labor productivity. And our productivity has been suffering and will continue to suffer. And so, you have to look at places like Japan, mm-hmm. where you have this overhang of the elderly and not enough youth to really be productive enough to save the economy. And so it is very concerning to me, Tom, that we are not increasing population at replacement rate, that we do have such a large elderly population that we're going to have to service in one way or the other. But it changes everything. We are going from a growth trajectory to, I think, a stagnant, if not declining productivity. And you have a lot of people out there talking about AI. Part of what I did when I left Mortgage proper was build technology, train large language models. Mm-hmm. And I can tell you that I don't have the same hope that I see in the marketplace. I definitely see that there are uses for this technology. I definitely see that it's going to be replacing certain jobs, but it is not going to lead, at least right now, because we don't have the power to generate it, into big gains in productivity. And so if we don't have something like that increasing productivity, then we are going to be in a declining economy. Really, we have been sort of average GDP has been going down since 2000, but we've still been able to putter along, but it could get even worse. And just the expense, on the debt side of meeting the obligations to that aging population is going to be massive. We're paying more interest expense now than we're getting in tax receipts. That's a big deal.
Mm-hmm. Melody, it's interesting to me as well to think about the differences and to try to understand the differences, let's say, between the US and, for example, Canada. I'm Canadian. I know the the Canadian housing market, or at least the Canadian mortgage market, a little bit better. And it's unbelievable to me to really get a handle on these differences, right? And I think the idea that these 30-year 3% mortgages have a big role to play here. In Canada, mortgages for the most part need to be renegotiated every, let's say, 3 to 5 years, where your rate ends up changing. If you've negotiated for a fixed rate, never mind if you had a variable rate that floats with the market. And it just makes me wonder if as the Western world becomes more and more interest rate sensitive, that this becomes a bigger problem in some of these other markets, and that ends up contributing to this larger recession as a whole.
Oh, absolutely. And, I'm laughing because I remember one of the first businesses we had to exit in our international lending group was Canada. Rocket Mortgage has just exited Canada.
Mm-hmm.
Very different. This is something I've studied, just the different. This is a very unique housing market. And there's been places that have tried to emulate it. But the reason it's very different is because the securitization market is so extreme with the government. But yeah, I think, I'm a fan of the original work of Eurodollar University. And I think that, this will be a globally synchronized downturn. And the issues, in fact, for instance, the China housing market and residential real estate are having impacts here. A lot of who was selling last spring were the Chinese in places like California and Florida. We've seen recent increases in buying, but that's from their lows. And so I do think that these issues in the other, and they're very different. And we could spend, honestly, that's probably a series of 12 books about the differences and how that all manifests in the economy. But the fact that you're going to have issues in all of these markets across the globe, we are globally synchronized. You can see just Canadians stopping travel to the United States was a massive deal to our tourism industry. It was a little overblown, I think, in the media, but it was still an impact. And the fact that they were pulling out of homes. And I think they were doing that for more reasons than what they said, because of their own issues. But yes, this is all interrelated. And so I think you could see kind of a global housing downturn yet again.
Mm-hmm. So, Melody, in some ways, if we see, I think obviously the situation is much different than in 2008. But how do you view the pain that needs to come within the housing market? Should we, kind of rip the Band-Aid off, get it over with, and this will reprice homes to be able to be available to these younger buyers? How do you think about this in a lot of ways, the destruction of this housing market and the way that it needs to be able to play out?
Yeah. What we need, what will happen. These are, but I can tell you, so where I am right now is I know that we're definitely going to get a near term correction, probably as violent, if not more so than what we saw in the GFC. Where I'm still a little uncertain right now is whether we'll get another little quick boost, another little, I wouldn't call it a bubble like it is now, but another little pop before everyone understands the long-term dynamics. I'm not completely certain on that, but what could happen here, Tom, is we could play this completely out. Meaning we return to the mean. And if you look at the household median income over time, and you look at the median home price, those correlated, fairly well together until you got the hyperfinancialization. And so I think we could go back to housing being very, very boring and really as tied to what that median income is. Right now, the household median income in the United States is around $80,000. Meaning that really you could only comfortably afford a house between $250,000 and $300,000. And so, that means violent corrections and many areas across. But here's the other thing. As those demographics play out, you're looking at somewhere like Japan right now, where a lot of U.S. citizens have gone over to buy these vacant homes for pennies on the dollar. And
Literally.
sometimes literally.
Yeah.
They're just giving them away. Like they've been giving houses away in our Northeast, our old Rust Belt cities as well, And so I think that you could get to a point where, it's not even tied to income anymore. So I think it's really going to be important what happens over the next 10 years in terms of, are we all going to be on UBI? What is the government response? How does this, I'm a fan of the fourth turning. How does this fourth turning, end up? What do we try and get wrong? And I'll know more in a couple of years, but right now I can say that in many ways, what we could see, even in what I'm calling a near-term correction, is the global financial crisis actually playing out. I help people who have default loans, Tom, because navigate the system, because it is a crazy Byzantine, it's a bad novel that I'll write someday. It's like Bartleby the Scrivener. It's crazy. So I help people, and they're like, they've inherited something, or their brother got a POA and took out a fraudulent loan, things like this. And I'm working on foreclosures that have been in foreclosure since 2007 right now. Multiple.
Wow.
And if you go to New York, that's most of their dockets. They've never come out of the system. And so you could quite frankly see that crisis finally play out. Will we get a bounce off that before we deal with our debt situation? We could, many years, but many people will be wrecked between then and now. But that I don't know. So, but the near term is that either there's a correction or we all get jobs that, sort of make it possible to afford these prices, which at the moment, that doesn't look likely. And as I've said on another show before, unless the robots need houses, our demographic picture is going to squash housing as an asset, as opposed to as an appreciating asset versus a depreciating asset, which is what everyone knows it truly to be. The land is supposed to be what appreciates. But with these property taxes, people are saying now, why would I even buy this land? I don't own it. You can come take it from me if I don't pay my property taxes, which have gone through the roof as the municipalities suffer because their American Rescue Act money is running out.
Mm-hmm. You mentioned in there this idea of a short-term pop back up, maybe. Explain to us a little bit about what that would look like and why we could get something like that. Is that something that is basically the Fed coming back into the market? What precipitates that?
So it's very so I have to entertain all possibilities,
Mm-hmm.
right? And I have to. So if you look at kind of where the people that do have these assets could make money, that's likely going to be the stock market over time. The stock market, I don't play in there. It's too crazy. It's a casino, but it might be, again, where that becomes, again, and I'm talking way out into the future, Tom, so I don't want to confuse people, where that becomes the only option again. But that's way further out. And with those kinds of returns, those returns kind of taking the place of productivity returns, for instance, if you get to such awful lows, those who are asset holders now in the housing market, if they then can come back in again, similar to how Blackstone came in at the end of the last crisis and sort of, kind of take up some of this inventory for renting out, and they might be able to save it just a little bit off the lows for a little while. But ultimately, I think the supply and demand story is the winner here, no matter what's going on in the economy. So it would be a very small bounce off the very, very lows. Similar, say maybe before everything went crazy in the GFC, like that, maybe that late 90s to 2002 kind of period where you started to see the appreciation, but not just how nuts it went from there. So I hate even kind of mentioning it. This is just something I've recently been thinking about, but it's not going to be enough to justify the economics of purchasing in this environment right this second.
Melody, what kind of policy responses do you think would be helpful at this point, if any, if this is a situation that can be somewhat mitigated at this point by instituting some type of policy? If going back to the old maybe magic wand idea.
Yeah, I think looking at our tax, the way that housing is, how we treat that in our tax system, this whole 1031 exchange, that really disincentivizes boomers from selling or, and getting out completely. And so I think looking at our tax code would be helpful, but mainly I would love for the government to get out of housing. And I think the biggest thing, Tom, which would be so transformative to our economy, it's hard for me to imagine it would happen. But if they got rid of securitizations and sort of the capital markets and housing, then housing could become boring again. And it could, go back to what it's supposed to be about, just someone buying shelter. And so it's hard for me I'm just a realist. I'm a pragmatist. So it's hard for me to talk about what could change everything when I know how unlikely it is right now. But, the biggest thing that would change the U.S. housing market would be to stop all securitization and related asset-backed security transactions. I mean, but you'd be talking about blowing up the Fed, you'd be talking about blowing up the Treasury, you'd be blowing up the entire Eurodollar system because MBS, mortgage-backed securities, are used throughout the system to pledge as collateral. And so it's hard to, but I think, I would start with tax code probably.
Yeah, it's such an interesting problem to try to unravel and even just to get a handle on, right?
Oh yeah. I mean, it's why a lot of people glaze over, when I start talking, because it is so complicated. You're like, it should just be as simple. I'm going to buy a house and the bank's giving me a loan. But if you're any homeowner in the United States, that you sign with one entity, you get a letter 30 days later and says your loan's been sold and you have no control over that. I mean, people talk about the Consumer Finance Protection Bureau, but that's why the CFPB was started, because you don't get to control who your mortgage servicer is. I get to control which bank I bank with. And I theoretically got this mortgage with that bank. Why can't I control who services my loan? Well, you can't. And so the CFPB was kind of created so you could at least complain to somebody. They're ineffective. I think they're ineffective. It's a lot of regulatory, competition. Not competition. They collude together, and it's a lot of duplicative efforts. And so I'm not a fan of the CFPB, but that is why they were created, is that you have no rights as a consumer in this system.
Well, Melody, as we wrap up here, is there anything that we haven't touched on that you think that you'd like to leave our audience to think about?
Yeah, I think that the biggest thing is this happens to all of us, something we know a lot about. We read somebody writing about it who has no idea what they're talking about. And you're like, wait a minute, wait. And if they can write about what that is, then how can they write about all this stuff like they know what they're talking about? And that's what happened to me in housing, is that I had a unique experience in mortgage finance and housing and was like, wait, this isn't right. And so the point of all this is that we have to stop listening to what everyone is telling us over and over in mainstream media and look for ourselves. And if we want to own a home, it is very complicated. And there are a lot of dynamics at play, way more than is there a good school in the area, especially if you're going to take out debt. And so what I would say is at this moment, I'm really encouraging people to say no to debt slavery, because we are in that point of the cycle where you thought you would have that good job for a really long time. You thought you could afford all that debt you were taking out for your mortgage, for your car, for your buy now, pay later, to Coachella. Unfortunately, we're getting to the part of the cycle where one of you is probably going to lose a job, or you might be losing benefits, something like this. And that debt is going to start becoming heavier, a heavier and heavier albatross around your neck. And so it's kind of a twofold message, Tom. It's you've got to pay when you make these big decisions in your life. You can't let others tell you what to do, either through because they're all selling you something. Mainstream media is trying to sell you something. So you're going to have to do the due diligence yourself. And then two, think very carefully at this point whether taking on all that debt is really going to be the best thing for you and your family. Because I don't care if it means you get to have a nice 3-bedroom. If you're fighting all the time, is it really worth it? And I know that's kind of a social message, but the housing market is not as they describe it. And, there's just more important considerations that you need to weigh when making those purchases.
100%. Well, Melody, of course, you write a lot about this stuff on your Substack as well as your Twitter page or X page. All of Melody's stuff is all available at M3_Melody and your YouTube as well,
Yes.
right?
Yes, that's correct. Thank you. Yeah.
Melody, that was really interesting and, a little bit of a departure from the norm, but I think it's really helpful to be able to understand this market and by proxy, the health of the U.S. economy and consumer as part of that. So I really appreciate your time today and look forward to checking in with you again.
Thank you so much for the opportunity. Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.